So welcome then to this last lecture this week, I guess so. I really appreciate that you guys made it and are still here and listening to this. Who here was already on Wednesday when we gave this other lecture? So that means that I don't need to necessarily introduce ourselves again, just very quickly. I do this together with my colleague Gonza, and just an overview again, we both work for Pendulum, which is a parachain project, and I'm the CTO and Gonza is the tech lead. We have been working on this parachain for now almost 1.5 years, but the parachain is now going to launch very soon, in actually 10 days. We won the auction just in December, and very proud that we can finally go live with this chain. We actually already have a Kusama parachain, which is called Amplitude. So this one is already live, has been working for half a year now. So we already made plenty of experience with how it means to actually run a parachain. And of course, it's much more exciting now to actually finally be on Polkadot. We've been really looking forward to this for a long time. Maybe also what Pendulum is about, very quickly again, because I already said it on Wednesday, our business mission is to connect fiat networks with the DeFi ecosystem, translated to maybe something more digestible. That actually means that we want to become the central hub for stablecoins on Polkadot. And when I say stablecoins, I particularly talk about fiat-based stablecoins. We think that all the fiat currencies of the world should be tokenized, and you should rather deal with them in the blockchain world, because we pretty much think that with DeFi, things can be done much more transparently and efficiently than in the traditional banking field. And particularly for this talk today, I want to focus on Forex markets, which is the foreign exchange market, or if you're not so familiar with these business terms, it is the market where you can exchange fiat currency. So whenever you travel to another country with a different currency and exchange your currency, like who's not from Argentina and came here and needs to do payments, then you always use the Forex market in order to exchange currencies. And for me at least, since I'm here, I find it very transparent in Argentina, because every time I do a credit card payment, I'm actually from Europe, and my bank account is in euros. Whenever I do a credit card payment, I feel like it's a game of luck which kind of exchange rate I get. And it's not just deviates by 10%, but actually by 100%. Either it's 1 to 200 or 1 to 400 or something even more wild. And as I said, very intransparent. And today we want to look at how we can actually do this with blockchain instead, once the fiat currencies are tokenized. So that's why I'm talking about, or we are talking about automated market makers, which is a very nice approach that how you can do any kind of markets on blockchain. And I will first talk about markets, so that's a little agenda. First, again, like on Wednesday, I will spend the first approximate half to talk about the topic, about more about the background theory. I will talk about markets, then automated market makers, and at the end also about another topic called Miner Extractable Value, which is quite interesting because it addresses some problems with automated market makers. And then at the end, we will do again another very simple exercise, which will allow you to actually implement your own very, very simple automated market maker within 40 minutes. Similar to what you did on Wednesday with the atomic swaps, but this time with an automated market maker. So first I want to talk about markets in general. That's, of course, quite obvious, this topic, for everyone who already did some used a stock exchange, a stock market, or particularly for you guys, probably the cryptocurrency market. I guess that most of you did some investment and used cryptocurrency markets. So I guess that this part of this lecture is quite obvious. But I want to start with some basics, because then it becomes more obvious why we talk about automated market makers. So in this example, let's not actually talk about currencies, but let's talk about the very simple market approach. And I have two farmers here, a sheep farmer who has a lot of sheep, and a wheat farmer who has a lot of wheat. And they want to exchange their sheep and wheat, because the sheep farmer wants to also bake some bread, for example, and the wheat farmer wants to produce some wool. And when they make this exchange, they somehow need to agree on a price. And I just want to look at two different scenarios here. Namely, when they make an exchange, both of them have some kind of minimum price or maximum price that they accept. I'd say that in this scenario, the sheep farmer wants to have at least 120 kilograms of wheat per sheep. Of course, it's at least. He would obviously be happy to get also more than 120 kilograms per sheep, because he has to give a sheep away, and if he gets 200 kilograms, that's also enough, but the minimum amount would be 120 kilograms. For the wheat farmer, it's the opposite. The wheat farmer has a maximum value that he wants to give away for a single sheep. So in this case, let's say the wheat farmer wants to give away at most 80 kilograms of wheat per sheep. And it becomes obvious that these two people, they will not come to agreement here because their terms are very different. They will not be able to do a trade. If you have a different scenario where it's the opposite, let's say the sheep farmer wants to have at least 80 kilos per wheat per sheep, and the wheat farmer wants to have would be willing to give at most 100 kilogram of wheat per sheep, then in this case it is obvious that they will be able to make a trade and come to an agreement. And I think it's much easier to look actually at some kind of diagram here. Here I just put the kilograms of wheat per sheep that they are willing to give or receive or to buy and to sell. And in the first scenario, again, the sheep farmer wanted to have at least 120 kilograms, and the wheat farmer was willing to give away at most 80 kilograms per sheep. And you see this here in these diagrams that obviously sheep farmer at least 120, that means that every price in this that's above the 120 would be fine, and for the wheat farmer everything below the 80 would be fine. But there's no overlap here, so they don't come to an agreement. And in the second scenario, it's quite clear that it works because now there is an overlap. And they can actually now trade any price between 80 and 100. Which one, it doesn't even matter. That's what they can decide that themselves, but at least there is some match. Now if you have many wheat farmers and many sheep farmers, then it actually gets much easier, because the more people you can potentially make a trade with, the higher the likelihood is that there is some match. And if you have many of these sheep farmers and wheat farmers, then the easiest way to check whether there are some kind of overlaps is to use this order book. Here in this example, I put every single wheat farmer into this diagram, and now I just made a very simple line. Let's say this wheat farmer says he would be willing to give away at most 125 kilograms of wheat per sheep, and this wheat farmer would only be willing to give away at most 70 kilograms. And I also put all the sheep farmers in there, and they have these blue lines. And it's quite obvious that some of them would be able to do trades and some of them would not be able to do trades. For an order book, it also makes much more sense to also put in the volume, not just the price, but also how much they're able to sell and how much they're able to buy, depending on whether they're a sheep farmer or wheat farmer. And now if you look at these volumes, then it's quite easy to check which ones are able to do a trade with each other. For example, this sheep farmer would be able to do a trade with this wheat farmer because they find a price anywhere in this area to do a trade with each other. And now it's just, if you try then to match them and to do this trade, you will see that not everything will be tradable, because the sheep farmer is willing to actually sell more sheep or to buy more wheat than this wheat farmer is able to give. So there will be, after they make a match and after they make a trade, there will be something left. But there's still, because there's this wheat farmer here, then all these sheep farmers are still able to do a trade, and they can then resolve their orders. Let's say they do this all together, and then let's say there is still, let's say this line is still so high that a little bit is left, even if this wheat farmer makes a trade with all these sheep farmers there, so that after they do this trade, then you would still have this little bit of liquidity left. But now it's obvious that there's no other trade possible. And this order book mechanism is, of course, something that you find on almost every stock market. I think this is how all the classical markets work, and also most crypto markets where you exchange any currencies. Now let's say there's also another new order that someone puts in, and if there is this order, that comes in from a new wheat farmer, obviously there would also not be another trade possible. But let's say that now there is yet another order coming in from another sheep farmer, and again you see that the trade is possible and can be resolved with each other. So at the end, whenever all trades are done, you would always have all the wheat farmers, the open offers, the open orders of the wheat farmers to the left, and the open orders of the sheep farmers to the right. So that in a very general view, after all orders have been resolved, you would always have this kind of view. Everything red to the left, everything blue to the right. But if you look at this diagram, then usually you don't display it like this because it's not so useful to have this kind of diagram. What you do instead is that you accumulate these views. So what I want to say is, if I'm a sheep farmer, I come to this market, I see this order book, and I am willing to, let's say, do a trade for up to 60 kilos of wheat for a single sheep. Let's say I'm very cheap. I don't care so much. I think that I don't need that much wheat, so I'm happy to even do a trade at 60 kilos of wheat. Then I want to know how much wheat I can actually buy for, let's say I have an unlimited amount of sheep and I want to know how much wheat I can buy. And in order to see this, I can do this accumulated view. The only difference between this view and that view is that I now always added this up. So here I take this bar, then I add this bar on top of this, and so on. And I do this also on the other side, and I get this view. That actually just means that, for example, if I'm willing to sell a sheep for at least 80 kilos of wheat as a sheep farmer, then I can get that amount of wheat in total at best, if I have unlimited number of sheep, for example. So that's the typical order view, order book view that you always see when you look somewhere online. And to do it a little bit more abstract and take the lines away, it would look like this. Or in a very general sense, it would just look like this. If you have many, many different orders, many small orders, then you see that the order book goes to the side and to the top. And then you would have always a little bit in between. There's a little spread in between, and the spread is just the difference between the highest sell order and the lowest buy order. Yeah? Sometimes the spread can be really narrow. Let's say you have a different order book. In this case, let's say the spread is very narrow, and in this one it's wider. And if you have an order book like this, it's obvious that it's more favorable for you if you want to make a trade, because you can still, if you want to sell or buy a lot, you can still get it to more favorable favorable price in this order book than in that order book. Because in that order book, if you really want to make a big purchase, you need to do it for a really bad price that deviates very much from the mid-market rate that's somewhere in between. And order books that have this kind of shape are, as I said, favorable. And you say that they have a, and actually this measure, when you see how narrow the order book is, how small the depth is, how small the spread is, and how quickly they rise, this is called the depth, and you want to have an order book that looks like this. Or what you also say, that there's a lot of liquidity in this order book. And the job of a market maker is, in the traditional market, the job of a market maker is to provide liquidity, that you always have an order book that looks like this and not like this. Because then anyone who comes to the market and wants to do a trade has a more favorable option to do the trade with the price that doesn't deviate too much from the mid-market rate. So that's the general view. That's a classical view. And as I said, a lot of markets online where you sell or buy cryptocurrency, it still looks like this. Or I took an order book that's an actual order book from I don't know anymore, but I just took the picture. I think it's Bitcoin versus US dollars, but this is how an order book would look like. You see that there are actually these little steps here, because there are, of course, single orders, and it's not that it always just goes up like a triangle, but every single step is an order, and when you accumulate them, then you see that it goes up like this. Okay. Now, I said what a classical market maker is. A market maker was, the idea of the market maker is to provide liquidity for such an order book market, but an automated market maker actually works very differently. And automated market makers have been, I think, invented for the cryptocurrency world because they're actually much easier, much simpler to maintain than what you just saw. So let's look at the very simple structure of an automated market maker. And this is a constant function market maker that I'm showing here because they are the most simplest ones and the most traditional ones. For a constant function market maker, you have let's put it like this, you have two jars. And let's say, let's forget about wheat and sheep. Let's really talk about currency now to make it something that's much more useful for our purposes. Let's say we have a constant function market maker for US dollars versus euros. And in this case, you have two jars, one with US dollars, one with euros. Someone needs to fill them initially. Let's say someone, maybe the owner of the market maker, fills these jars with 3 coins each. And these jars are of course not called jars, but they're actually called liquidity pools because they provide the liquidity that the market maker can work with. Now, every state of that market maker is determined by the number of US dollars and by the number of euros in these liquidity pools. And for that reason, every state can be represented by 2 numbers. And to make it much more graphical, you can put this state as a single dot in a diagram because they're just 2 numbers. So you have a coordinate consisting of the euro amount and the US dollar amount in these jars, in these liquidity pools. And you can represent it by this red dot that you see there. In this case, obviously, US dollars and euro amounts are the same. That's why the dot is somewhere on the diagonal right now. Now, something that's really important for this constant market maker, constant function market maker, is that they define such a curve. You see this blue curve. And this blue curve is defined once for this market maker, and the market maker now ensures that whatever happens to these liquidity pools, it will ensure that the current state always stays on this curve. Now, if someone wants to interact now with this market maker, and let's say someone wants to exchange dollars for euros, so I have dollars, I want to trade them, and I want to receive euros, and I can go to this market maker, interact with this, put some US dollars into the jar. Yeah? Let's say I have 2 US dollars, I put them in the jar, and that actually means that the state will now be lifted by 2. So the state goes up to this point, and of course I'm not now allowed to take some euros out of this other jar, but the market maker now demands that the number of euros that it can take out needs to be so that the point at the end lands on this curve again. In this case, let's say this is 2 euros. How much was it? There were 3 euros in there. After this, it's only 2 euros. Actually, you see that on this diagram, it's a little different. Okay, I put 3 US dollars in and was allowed to take 2 euros out. Quite easy. Of course, I can also do this in the other direction. Let's go back to the initial state, and let's say I want to do the opposite. I have euros that I want to trade for US dollars. So I put some euros in the jar, and in this case, the euros, and take 2 US dollars out. And it's quite obvious that it would work in the same way. Euros in, and take US dollars out, and that dot goes down there. And let's say in this new state, I make another trade. Someone else comes along and wants to, has even more euros that this other person wants to exchange for US dollars. So let's say this other person, let's count here, we have 6 euros. This other person comes along and puts in another 2 euros. So this dot will be moved another 2 euros to the side. And what is obvious is that because the curve is flatter in this area, in this case, this next person is only allowed to take half a dollar out. Not $1 or $2 anymore, but only half a dollar, because this arrow now is much smaller than the one that I had before. And it becomes obvious that the more trades that will happen now, the more I go along this curve, because it gets flatter and flatter, that the exchange rate will get more extreme and more extreme. So for the same amount of euros I put into the jar, I can take fewer and fewer US dollars out. And it also makes sense because there are not a lot of US dollars left anymore. There will always, as the curve never reaches, so in this case, let's imagine that this curve never actually reaches the axis, but always stays above, only asymptotically reaches the axis. There would always be a little bit of US dollars left, but it would be less and less that I can take out. Now, let's talk about exchange rate now. What is the exchange rate? Let's go back to the original trade that I looked at, and in this case, let's look at the differences of euros and US dollars. So in this case, we already looked at this. The difference of US dollars is 3, and delta euro was 2. And the exchange rate, obviously, is just the ratio of the differences. And the ratio of the differences, if you look at this, is just the negative slope. You know that the slope is defined as the y difference divided by the x difference. And if you look at this, then you see that this is exactly the slope that we see there. So whenever you do a trade with the market maker, it's very easy to see what actual exchange rate you get when you do this. But now let's look at different examples. Because you see that if we start at this red dot, and I now come along and want to trade some euros for US dollars, then it becomes obvious that the exchange rate that I actually get depends on the amount of euros I want to change. So if I just have a small euro amount, like this one, then you see that the curve is actually still quite steep. That means that the exchange rate is still quite high. Let's say I'm somewhere here. Because on this diagram, I put down the difference in euros that I want to trade. Now, if I trade more, you see that the more I trade, the more euros I'm willing or I want to exchange, the more flat the curve gets, the more flat the exchange rate gets. And that's what I show here on this diagram. The higher the euro amount that I want to trade, the lower the exchange rate is. And actually it gets more unfavorable and more unfavorable to me the more I want to exchange with the automated market maker. Now something that maybe gets also quite obvious is if I look at a really, really tiny amount that I want to trade with the market maker, then the exchange rate that I get for this really tiny amount is obviously the slope of the tangent at that point where I'm at the beginning. That's the green line. And that's what you call the marginal exchange rate in economy. So the marginal exchange rate is the exchange rate I would get when I only exchange a really, really tiny amount with the market maker, and that's actually the most optimal exchange rate I would get in this case. Now, what you don't want as a user of the market maker is you don't want to have a situation where the exchange rate is really so sensitive to the amount that you exchange with it. If you want to exchange a lot or just a little, you basically want to have the same exchange rate. You don't want that the market maker gives you a bad exchange rate just because you want to exchange a lot of money with it. So if you want to now build a market maker that allows the user to also exchange a lot of money without getting a worse exchange rate, then you need to actually construct a different market maker with a different curve. And a curve that would look like this is, for example, this curve. Now, if you look at this curve, you see that the slope that the user will get when the user does different trades along this line is basically almost always the same as long as the user stays somewhere in this area. So if the trade is really extreme, then it also gets flatter, but if it stays in this area, it will always be the same exchange rate. And that's what I actually show in this diagram. You see if up to a certain point, the exchange rate is basically always the same, so it's not very sensitive to the amount of the volume that the user wants to trade, and that's, of course, much nicer for the end user. And the term for this sensitivity is called slippage. A market maker with a high slippage, that's what we showed here, is very sensitive to these kind of amounts, and a market maker with low slippage is not sensitive to these amounts. Now let's look at some models that we can define in order to see whether how we can give a low slippage to the end user. Let's look at the first model that I showed. This is a market maker where the curve is quite even at every point. This is actually called a constant product market maker. At the beginning, I called all these market makers constant function market makers. That's the general term. But now the special term for this first kind of market maker is constant product market maker. And the whole reason is that the curve is defined in a way that the product of US dollars and euros is constant. And if you just turn it around, you see that this is actually just the definition of a hyperbola. So a hyperbola always has this nice same curve at every point. But that means that you have a high slippage. The other extreme is a market maker that gives exactly the same exchange rate everywhere, which basically has no slippage at all. And this is a market maker that has exactly the same slope everywhere. And it's quite obvious that for this market maker, you have no slippage. That means that if you start here and independent of how much you exchange, you always get exactly the same exchange rate because the slope is everywhere the same. Such a market maker would be called the constant sum market maker because the sum of US dollars and euros is defined to be equal everywhere. And that's why you just have this line. Now, it is, on the other hand, obvious that this is maybe not the best market maker you can find because the problem is that this market maker will be exhausted at one point in time. If someone wants to exchange a really high value, then because the market maker really hits the line, the axis at this point and also at that point, there is a point in time, or there is an amount where you cannot exchange any more with the market maker. For example, if the market maker is here and you want to give some euros to the market maker, you can only give this amount until you get to this point. You cannot exchange any more. And you actually don't want to have market makers with these kind of limits. And for that reason, you can then define a hybrid market maker. That's actually something that's very common, that you have these hybrids of both models, where for some range, you have something like looks more like a constant sum market maker, but at the extreme end, you go over to a constant product market maker. And what's so good about this kind of hybrid model is that you have in some main area really good slippage or really low slippage, but you still can trade really extreme values if you want to, so that there is no limit to the amount that you want to exchange. Such a market maker is actually really good for any kind of stable coins that actually represent the same currency. For example, on Wednesday I talked about wrapped tokens. I talked about ETH, and I talked about WETH, so wrapped ETH. But ETH and wrapped ETH actually represent exactly the same currency. The only thing is that one is the wrapped version and the other one is the original version. But you actually expect that if you put both of them into a market maker in order to exchange the wrapped token back into the normal token, that they would always be tradable one-to-one, and that they basically always stay in the same area of this curve, so that you never go to the extreme ends where the exchange rate gets really extreme, but the exchange rate would always stay at the same point. And so particularly for these kind of token pairs, it makes a lot of sense to use this kind of hybrid model. Now let me talk about some effects of these market makers, some implications of this very simple model. The first one is arbitrage, and that's actually something that's very important to understand. Let's look at a market maker, and let's say the market maker is in the state of the red point. We already talked about the marginal exchange rate. That's actually the exchange rate that the market maker provides in that moment. If you want to interact with the market maker and you just have a very small increment that you want to exchange with the market maker, you get this marginal exchange rate. And of course, the bigger the amount is, the more it deviates from that. To the left and to the right, it deviates in different direction, but the marginal exchange rate is the exchange rate of the market maker in that moment. But this exchange rate might be very different from the actual exchange rate. If you talk about, for example, euros and US dollars, of course you can always look at Yahoo Finance or on the internet about what the actual exchange rate is in this moment. And it can massively deviate from the exchange rate of the market maker, of course, because your market maker is maybe just at that point, because maybe you just started the market maker and you put liquidity up on that market maker, and due to this liquidity, the point is at that place, but it's very different to the actual market rate. So that's why I said that there could be a very big global market, and the market rate at this big global market might be very different. Let's say it's actually this green line. The green line, let's say, represents the slope or the exchange rate of the global market, and they are different at that point. Now, what would happen? Of course, you know that if you have two marketplaces with different exchange rates, that you can always do arbitrage if the fees are not too high. But I think that everyone here is familiar with arbitrage, or is that not the case? Okay, so if you do arbitrage now, and let's say the big global market is so big that even if you make really big sales, that you can basically not really change the market rate of this big global market, only if you're really a billionaire or whatever. But with some small amounts, you will not be able to move that market rate, the big market exchange rate, to any other place. But of course, when you do arbitrage, you will definitely have an impact on the automated market maker, and you will change the red dot. What will happen? What will actually happen if you now do arbitrage with a big global market? Well, I don't want to go into the details, but it becomes obvious that as long as you do arbitrage, the arbitrage will always push the red dot or the current state to a place where the exchange rate of the market maker will agree with the exchange rate of the global market. Yeah, it will not be in the other direction, but it will really be that direction. That means that as long as the market maker is open for arbitrage, as long as that is open for arbitrage, the arbitrageurs will always come in and push the market rate of the market maker so that it agrees with the actual market rate. And that's actually really, really cool, because you don't need any oracle or whatever. The market maker, just by being open to arbitrageurs, will always, after some time, assume the actual market rate of the actual market out there. And that means that if you have a cryptocurrency protocol, you don't even need to see what's going on outside. You can just look at your market maker, and you will, if there's enough liquidity in there, you will most likely see that the exchange rate of the market maker is really the actual exchange rate out there. And I think that's a very cool model, that you don't need any oracle in order to achieve that. But it has a problem, and that's what I want to talk about now. Like this effect that the market rate of the market maker will basically always agree with the actual market rate out there is really good for the user who wants to use the market maker, because they will be able to find an automated market maker that gives them the price that they also find in the real world. But it has a problem for the people that provide the liquidity to the market maker. You see, every market maker has different kinds of people that interact with this. The most important ones are the ones that we talked about, namely the ones that exchange currency with the market maker. But you also have the users that provide the liquidity. Someone needs to provide the liquidity, and so far we said that the person that put up the market maker put in the first coins into these jars. But in the real world, you would probably not do it yourself, but you find some investors that are willing to give some liquidity to you. Something that I didn't say is, and maybe it's obvious, that the more liquidity you have in these pools, the lower the slippage is. Because if you have a lot of liquidity in these pools, that actually means that this blue line is not down here, but it's really, really far outside. So you need to zoom out to see the big picture again. And that actually means that you just change the scale of this graph. So the diagram would actually look the same, the shape would look the same, but the scale is very different. If you have low liquidity, maybe here is 10 euros and there you have 10 euros, like on this diagram. But if you have really a lot of liquidity in there, then that actually means that here's maybe 10 million euros and there you have 10 million US dollars, or even more. Like the actual market makers that are out there have a lot of liquidity. And that actually means that if you come now in and want to trade 1,000 euros, that you actually move that dot just tiny, tiny amounts around, because you have really, really big scales. And that means that if you trade now with this market maker, even with $1,000, and you just move that dot around really, really tiny amounts, that means that you actually almost get the exchange rate, the marginal exchange rate, because you stay really much at that area. So the higher the liquidity in these liquidity pools, the better it is for the end users, because even with high amounts that they change, they get almost the marginal exchange rate. Pretty good, I guess so. Now, if you want to have a lot of liquidity, you need to convince people to give you that liquidity. But these people are exposed to a lot of risk because of these arbitrageurs. Now, let's assume that over time, let's say some people provide liquidity to you. You could convince some of them, some ways. They put $1 million US dollars and 1 million euros in there. And now the market maker works, does what it's supposed to do. And 1 year later, you see that for whatever reason, the euro got devalued and the US dollar became much more valuable compared to the euro. Now that would mean that, that the exchange rate of the US dollar and euro in the market maker would also appreciate the value that you have outside because of the arbitrageurs. So arbitrageurs over time would then push that dot more to this place because now the exchange rate is less favorable to euros. But what that actually means is that at the end you have much more euros in your liquidity pool than US dollars. You can see this obviously on this diagram. Almost no US dollars anymore, but a lot of euros. But what does that actually mean? Well, that actually means that the liquidity providers now have a lot of the token that almost doesn't have any value anymore, namely the euro, but they have, I need to go back to the previous one. Oh no. They have a lot of the token that has almost no value anymore, but they almost don't have any of the token that now has the high value. That means that if you look at this as a portfolio that the liquidity provider invested in, that the whole portfolio has less value than it had before. So the liquidity providers lose money or lose value in their portfolio. And this is actually called impermanent loss, this effect. That means that whenever the exchange rate over time deviates from the original exchange rate, and over time that will always happen, there will be some deviations, that means that the portfolio will always decrease in value. Even if it goes in the other direction. If it goes in the other direction, it means that US dollar has less value than the euro, but you have then many more US dollars than euros in these liquidity pools. So the liquidity providers, they will always lose, actually. But this is called impermanent loss, and the reason it's impermanent is that the exchange rate will most likely also go back at one point in time. Let's say it's a random walk, it goes up, it goes back, goes down. So at one point it might go back to original value, and then all the value is back to the original value, to the original point. So the more it deviates from the original point, the lower the value, but if it comes back, then the value is back to the original valuation. That's why it's called impermanent loss. But it's definitely a risk that every liquidity provider needs to face. Now, why would any liquidity provider then provide any liquidity to your automated market maker? Of course, they need to get some returns. They need to have some incentives, and obviously you would require some fees from the users that use the automated market maker. Now, what I showed so far was a model without fees. In this model, that's what I showed there. You can, starting at the red dot, at the red position, you can exchange in both directions. And we already saw this diagram, what that actually means for the exchange rate. I now drew actually both directions with positive delta amount for euros, but also with negative delta amount for euros. Let's say this is 0 delta amount, so this is the marginal exchange rate. And whenever someone wants to exchange a positive euro amount, then the exchange rate goes lower and lower. But in the other direction, the exchange rate gets higher and higher. And you see that here at this point, the exchange rates, they really touch. And what you have here is this marginal exchange rate. Now, that's a model without fees. Now, if you want to have fees, what you actually do is, I need to show the difference. Here you see that the arrows really go back to the curve. But when you have fees, what you do is that, for example, let's say someone exchanges euros for US dollars. That means someone gives euros to the automated market maker and usually would get a high amount of US dollars back, namely so that the curve goes back, the dot goes back to the curve. If you have fees, you would not give all that possible amount back to the user, but a smaller amount, so that actually the dot would end up above the curve. Also in the other direction, if someone wants to exchange US dollars for euros, then they would put US dollars into the automatic market maker, but they don't get the full amount of euros out of the automatic market maker, but a smaller amount. So you just land above that curve, and the remaining amount would then be given to the liquidity providers. That easy. But what that actually means for the exchange rate, you can see it here, is then that you have a break here. So the marginal exchange rate is actually somewhere here, but the exchange rate in the positive direction, the exchange rate in negative direction would definitely deviate from that marginal exchange rate. So that is very similar to the situation that you saw with the order book, where you have a spread between the one side of the orders and the other side of the orders. Without fees, you actually don't have any spread because it touches, but with fees, you have a spread. And that's very similar to the mechanism that you know with order books. Yeah. What you usually do is that you issue a liquidity provider token. That's a token that the automatic market maker uses to keep track of who provided liquidity. That means if you give liquidity, if you are some of these people that give liquidity to the to these liquidity pools, then the market maker issues a token to you, and that token will then represent how much liquidity you gave, and use that token in order to participate in the fees of the market maker. The more tokens you have, the more fees you get from the market maker that the market maker used. Now there is one other model that will also protect from impermanent loss. I said that the liquidity providers, they will get fees as incentives, but there are better models in order to protect liquidity providers from impermanent loss. And this model is a proactive market maker. You know, let's go back to this model. We said already that arbitrageurs will push the point to a different point if the external market rate changed. And that effect will actually lead to this impermanent loss, because this pushing around leads to a situation where you end up with more of the less valuable token. But the proactive market maker uses a different model. The proactive market maker now uses an external price feed, and it dynamically changes the curve. So let's say the user is at, the market maker is at this point, and now the market maker observes, using that price feed oracle, that the external exchange rate of these two token pairs changed. Let's say originally the exchange rate was exactly the same as in the market maker, namely this slope, and now the exchange rate changed, namely it took more like this slope. Then the market maker will use that price feed, will adapt the curve, pivot it, so to say, so that arbitrageurs will not need to push that dot around in order to achieve a different exchange rate of the market maker, but the market maker does it itself. And that is pretty good for the liquidity providers, because they will now not end up in a situation where suddenly there is much more of the less valuable token in the liquidity pool. Yeah, so finally I want to give an overview of different market makers that you might have heard already. Uniswap is a very common one, which is a constant function market maker, similar to what I showed, this hybrid model. Then you have Curve. This is also a constant function market maker, but it's actually more advanced because you also have multiple liquidity pools. I actually showed this on the slide here. Let's say you have 3 different currencies. The market makers that I showed so far only deal with 2 currencies, always with a single currency pair. If you want to use these kind of market makers for 3 currencies, you would actually need to have 3 different market makers in the scenario, 1 for each currency pair, and that would of course scale quite radically with the number of tokens you have, and that's very inefficient if you now have a lot of different market makers. And then of course you can invent a model that is able to deal with multiple liquidity pools at once. So you have only 1 market maker. This 1 market maker has now 1 liquidity pool for every currency and would be able to exchange any currency against another currency using this. Don't want to go into details because I cannot represent this curve in a 2-dimensional form anymore, but you can imagine that this curve that you saw in a 2-dimensional form now becomes a 3-dimensional curved plane. So it's a 3-dimensional triangle, so to say, which is curved. Maybe you can imagine that in your head, but I cannot draw it that easily, but it's possible to do it that way, and you can scale it to a higher dimension then also. That's what Curve does, because they have this curve. Then we have a market maker which is called OX Amber, which is very advanced because it's a proactive market maker, and it will actually be released on Pendulum very soon. And then we have another market maker called StateSwap. I don't know all the details about this yet, but it's actually something that is proposed to be integrated directly in Polkadot to exchange DOT versus, for example, USDC or other currencies. But I think so far it's just a proposal. All the details are not defined about this yet, as far as I know, right? Or is it? Yeah, then I'm not. Okay, so you can say more about this. We are actually already at the end. Maybe we have 2 more minutes to talk about this, but we can skip this topic, or then we can rather, or do we have time for this? It's like a few more slides. Which is also an interesting topic when it comes to market makers, namely Miner Extractable Value, or MEV. And maybe you've heard about this, but I want to show an example of what that actually means. Let's say we have a transaction. You now want to interact with the market maker, and let's say you now say that you want to do this exchange that's displayed there. If you want to do this, you create a transaction, and you submit that transaction to the blockchain. This transaction, for example, says you want to exchange with the market maker, you want to give 100 euros to the market maker, and the market maker would then give US dollars, the respective amount of US dollars back to you. And I put it very simple here, but every transaction, of course, also has a fee. Let's say this transaction has a fee of 1,000 whatever units used on the blockchain that we look at here. That's just a normal transaction fee that you have on every blockchain. And before this transaction will actually be executed, it first goes to the transaction pool and becomes visible to everyone. Yeah, the transaction pool is public, and particularly if you are a node operator in the network, of course you can see all the transactions in the transaction pool because you yourself manage such a transaction pool. Now what you can do, if you see this, and if you maybe operate your own node, you can extract value from this. If you are able to create your own block, so let's say you're one of the collator nodes or validator nodes on Polkadot, and you're able to have the power to create and propose a block. What you can do is that you now add 2 additional transactions to the existing transaction to get value out of this. And these transactions would, for example, look like this. You first add a transaction with a higher fee, and let's assume we work in a blockchain where the transactions in the block will be ordered by the fee, so that then the block creator or the collator or whoever can author the block will always first execute the transaction with the highest fee, then with the next highest fee, and so on. And now the person that makes a sandwich attack would then create these 2 transactions. The first one would also be a transaction that exchanges 100 euros. And let's say the last transaction would be one that exchanges 50 euros. And let's say the fee for this last transaction is lower than the transaction that you provided, and the fee of the first transaction is higher. And here you see why this is called a sandwich attack. Now, what would actually happen if you have this scenario? You see, originally, this would have happened. But with this new scenario, you have something else. First, the blockchain would execute exactly the original transaction that you wanted to be executed. Then it would execute your transaction. But you see, when your transaction is executed, the AMM is already at a different point. And since the transaction says also exchange 100 euros, it would also go up 100 euros, exactly like here. But the amount that you go back receive from the AMM is now less than what you would actually have received from the AMM. So you lose. Because of this transaction that the attacker put in the transaction pool, you now lose value. And the last transaction, let's say, is a transaction that exactly reverses the transaction that you executed. Namely, it's a transaction in a different direction, namely to exchange 50 US dollars. Let's say the attacker calculated precisely how much is required here in order to reverse this last transaction. You see that at the end, the AMM lands exactly at the point where it would have landed if it just executed your transaction, but you actually lost some value. You got fewer US dollars, but the attacker received some value. Namely, the attacker received the value that you didn't get. And the attacker doesn't lose any money, it gets exactly 100 euros back, but it actually wins these $50 that you didn't get. And that's a real problem. So that happens actually a lot with all kind of market makers. And there are two different approaches to solve this. That's also my last slide. There are two different approaches, and there are actually also two different parachains that will, at one point, I think they are not on Polkadot yet. I think they're just on Kusama, but they built some really great technology so that you can use in order to protect against MEV. One of them is Mangata. Mangata is an MEV protection mechanism that will ensure that the transactions that go into a block will actually be randomized, so to say. There's in a cryptographically secure way so that you're not able to predict how these transactions are executed. And if there's some attacker who wants to do a sandwich attack, there would be a high chance that it at the end will not create the sandwich that they want, but the execution order would be random. And then there's a high chance that it's not you losing, but it's actually the attacker losing money. And then they don't have an incentive anymore to do a sandwich attack. The other solution would be Manta Network, who works on zero-knowledge proofs. Actually, they're not working on solving MEV, but generally is a zero-knowledge technology, but you can also use zero-knowledge proofs in order to hide what you want to do. And if an attacker doesn't see what you do in your transaction, they will not be able to create an according sandwich attack for that. I don't think that Manta is particularly working on solving MEV, but I just want to say in general, zero-knowledge proofs are another approach to hiding your transaction and to secure against MEV. That's now the end of the talk, and I would hand over to Gonza to implement a market maker. Questions? Okay. Any questions, anyone? No.
Or I can use this one, maybe. Yeah, it's the same. Oh, okay. You did have a question then.
At the end of the talk, there was mentioned that there is a market being developed in Pendulum. Is this the main feature of Pendulum, or it's just one of them?
No, yeah. I didn't want to talk too much about Pendulum because it's the Polkadot Academy, not the Pendulum Academy, but of course I'm very happy to answer that question. Pendulum will actually create a whole ecosystem of market makers, or will be optimized to be a breeding ground of an ecosystem of market makers. And Amber is just the first project that we'll launch on Pendulum, and we are very happy and very proud that we can host Amber because it's a proactive market maker, has some really great other advanced ideas. They published a white paper a few months ago about this, and but I cannot go too deep into the details now because it's a little bit more complex, the ideas they use, but it's particularly tailor-made for the Forex market or for stablecoins. There are a lot of market makers that are not tailor-made for stablecoins, but this one is directly made for stablecoins. It has a different risk profile and different liquidity, different curves that are optimized for coins that are not too volatile. Yeah? Whereas other market makers are maybe for Bitcoin or for other cryptocurrencies, they need to deal with more volatile valued assets.
You can still search it on the web because there's a white paper. It's pretty good.
There is just one thing more. Why they are not called DEX? What's the difference, or is just the name?
I think, I also don't know when you use the word DEX, but I think it just includes everything. Sometimes DEX and automatic market maker is used interchangeably, But there are also DEXs that are not based on automated market makers. For example, on Stellar, I already talked about Stellar 2 days ago. Stellar is a blockchain that includes an automated market maker, that includes both an automated market maker and something they call a DEX, but their DEX is an order book DEX. So it's really like what I talked about in the first half of the talk. It's about classical order book mechanism. So they have both things included, market maker and the order book thing. So a DEX might be a more general notion for all kind of exchanges that use all kind of mechanisms, whereas the market maker is really what you saw here with the liquidity pools and the curve.
So, do you hear me right? Hi again, guys. So today we are going to follow up on what Torsten has been talking. Really awesome presentation, thanks. So I hope you get something from it. And we are actually going to execute a very simple AMM version, which is already included in the same repo of last Wednesday. So if you have your laptops on hand, then you can already go to this Pendulum Chain Blockchain Academy exercises and clone the repo. Or if you already have done that on Wednesday, then you can reuse it, of course. And in that same repo, then you'll find an AMM palette. This is, actually, we are going to implement a constant product, AMM, which was one of the constant functions AMMs that Torsten explained. And so in this case, you also have these 3 branches that you can use. You have the exercise, which is completely empty. You have 3 extrinsics of this palette that are unimplemented and that you need to fulfill. You can check out the hints branch, and then you'll find some comments about how to guide you over the exercise. And finally, you have the answers, where you can also check out and take some inspiration if you want to, if you're like super lost. But also let you know that this is a super simple exercise. This kind of exercises that like put your self-esteem up if you're studying. So hope that you enjoy it. So some clarifications. Again, we are implementing a constant product market maker. And for this, you will need to implement 3 extrinsics. So you need to provide liquidity. You remember the 2 jars, USD and Euro. So you need to provide like the starting liquidity, which is usually you will want to give the same amount, or at least very similar amounts of let's say, Euro and USDC, so the price, it's balanced. And then you want to implement the swap from providing Euros and getting USDC, and the other way around. For this, you can use, again, as the same as in Wednesday, you have the pallet's account address that you can derive. This is already provided in the implementation, so you can access it by calling self-account ID. This means that if you transfer something to self-account ID, then this will hold like the pool of the AMM. It will be, you will have that for storing the 2 pools, let's say. And for that purpose, you have already included 2 assets, this Euro and USDC. So this is using the palette assets, same as last Wednesday exercise. So basically, the only thing you need is to do this calculation, which is basically, if you remember the curve the first curve that Torsten mentioned, is a constant product. And this means like this is the constant, this is the product of the balances of the USD and the Euro that you have in your jars. And X would be the amount that you provide to swap, and S of X would be like the swap result. So what you are giving to the user, what the AMM is giving back to you. So let's say that X is the amount of euros that you want to provide to the pool, and you want some USD back, right? So you already had this, so you perform this multiplication first. And then you are adding some X to the balance of existing balance of euros that you had. So then if you divide this, you get the new the new USDC balance. So if you then perform the subtraction of the balance that you had and this, then you will have what you're giving back to the user. So as you see, it's very simple. Here, if you already have the slides available, I don't know, then you can, well, as a reminder, you have this. You already know two balances. The variable is the thing that the user inputs, and then you need to calculate S of X. So very simple. Then the swap to USD to euro, this is the the nice part. It's already the same, but the other way around, so you already know. I will leave you with it, maybe with this slide, as a reminder of what you need. And again, any questions that you have, this is very simple. You have, I think we still have some minutes left, but if you don't want to do it today, maybe you can save it for later. But anyways, we are here to solve your questions regarding even the exercise or the talk. And so let's dedicate some minutes to that. And yeah, thank you.